Let's cut right to the chase. The biggest news dominating headlines and shaping market expectations this morning is the appointment of Kevin Warsh as the new Federal Reserve Chairman. This is not just a change of guard, it's a potential paradigm shift in monetary policy. His appointment instantly casts a new light on everything from interest rate expectations to the Fed's stance on inflation and economic growth. The market is now calibrating, attempting to discern the implications of this change, and it's understandably leading to some pre-market jitters. We'll be diving deep into what Warsh's leadership could mean for your portfolios and the broader economy throughout our discussion today. This morning, the chorus of influential voices is particularly resonant, and it's impossible to start anywhere but with our new Fed chair, Kevin Warsh. His appointment immediately raises questions about the future direction of monetary policy. Many are speculating on his leanings. Will he be more inclined towards aggressive inflation fighting, potentially through a firmer stance on interest rates, or will he prioritize growth and market stability? The initial read suggests a pivot towards price stability, a sentiment echoed by some analysts who believe his tenure could introduce a new era of fiscal discipline. This is a critical development that could re-anchor market expectations for years to come. Beyond Warsh, we hear from the Dallas Fed president, who stated the Fed's current interest rate stance is well positioned. This is an interesting commentary, as it sets the stage for Warsh to either maintain that positioning or initiate a strategic shift. We'll be watching closely to see how the new chair interprets and acts upon this inherited policy landscape. On the corporate front, Jamie Dimon delivered some rather pointed comments regarding taxation, expressing a willingness to pay higher taxes if the funds genuinely reach those in need, rather than being absorbed by what he termed the Washington swamp. This speaks volumes about corporate sentiment towards fiscal policy and government spending. In the tech space, we have conflicting signals. Jensen Huang, a titan in the semiconductor world, offered a word of caution to investors too quick to dump software stocks. This suggests he sees underlying value and long-term growth potential in the sector, despite any current market headwinds. However, on the other side of the ledger, Michael Burry, known for his prescient market calls, sees a concerning head and shoulders pattern in Palantir stock, hinting at significant downside risk. These contrasting views highlight the current market's struggle to find a clear direction in a rapidly evolving tech landscape. Finally, Larry Fink of BlackRock has highlighted the growing economic anxiety among younger generations, attributing it, in part, to previous generations' self-focus. This insightful commentary underscores a broader societal and economic challenge that the new Fed chair will undoubtedly inherit, bridging the gap between economic growth and equitable prosperity. The bond market, often seen as the true pulse of the economy, is going to be under an intense spotlight with Kevin Warsh at the helm of the Federal Reserve. While we don't have explicit bond yield data in our overnight snapshot, the implications are profound. Historically, a new Fed chair brings an element of uncertainty, and Warsh is no exception. His past writings and statements will be dissected for clues about his preferred approach to monetary policy, specifically regarding bond purchasing programs, quantitative easing, and most critically, the trajectory of interest rates. A Fed chair who prioritizes price stability and a more disciplined fiscal approach could lead to a repricing of bonds, particularly longer-dated government securities. This could mean upward pressure on yields, reflecting an expectation of less accommodative monetary policy or a stronger stance against inflation. Investors will be scrutinizing every utterance, every policy hint from the new Fed to gauge the extent of this potential shift. The Dallas Fed president's assertion that the current interest rate stance is well-positioned provides an initial baseline, but the market's focus has unequivocally shifted to how Kevin Warsh will interpret and act upon that position. The bond market will be the first and most critical barometer of this new era. The central bank narrative this morning is, without a doubt, dominated by the Federal Reserve and its new leader, Kevin Warsh. This appointment is a defining moment for global monetary policy. The critical question everyone is asking is, how much power does a Fed chair truly have? While the Fed operates as a committee, the chair's influence on shaping the agenda, guiding consensus, and communicating policy direction is immense. Warsh's philosophy on inflation, employment, and financial stability will now set the tone for the world's most powerful central bank. We anticipate a period of intense observation as markets try to front-run his anticipated policy changes. Looking across the Atlantic, the European Central Bank is grappling with its own set of challenges. ECB economists are projecting that Eurozone inflation could be impacted by tariffs, though potential rate cuts could offer some offset. This highlights the delicate balancing act central banks face globally: managing inflation, supporting growth, and navigating geopolitical trade tensions. Christine Lagarde, as the president of the ECB, continues to steer through these complex waters, offering a comparative perspective to the imminent policy shifts we might see from the Fed. Meanwhile, the UK CPI preview suggests a fresh and marked fall in inflation is expected. This could give the Bank of England some room to maneuver, potentially leading to a more dovish stance, further illustrating the divergence in economic conditions and policy responses across major global economies. All eyes, however, remain firmly fixed on Washington and the first signals from the Kevin Warsh-led Federal Reserve. Turning our attention to the global commodities markets, we see a fascinating interplay of supply, demand, and geopolitical factors at play this morning. Oil is showing some resilience overnight, even as news emerged of a U.S. crude oil inventory build. This build typically puts downward pressure on prices, suggesting that other factors, perhaps lingering geopolitical tensions or a more optimistic long-term demand outlook, are currently outweighing the immediate supply indicators. Investors are likely looking beyond short-term data points, anticipating future energy needs and potential supply disruptions. This bullish tilt, despite the inventory data, indicates a fundamental strength or at least a deeply embedded belief in the commodity's value. Gold, often perceived as the ultimate safe haven, is experiencing a slight pullback in futures overnight. This comes amidst ongoing speculation about its future trajectory, with some analysts asking if it will touch new highs in the coming days. The new Fed chair, Kevin Warsh, and his potential stance on interest rates and inflation could heavily influence gold's appeal. If Warsh adopts a more hawkish approach, leading to higher real interest rates, the opportunity cost of holding non-yielding gold could increase, potentially dampening its allure. Conversely, any perceived instability or significant inflationary pressures under his tenure could send investors flocking back to the yellow metal. It's a battle between two powerful forces right now. Natural gas futures are also seeing a modest dip, testing key support levels. This commodity often reacts strongly to weather patterns, inventory levels, and industrial demand. The current slight softness could reflect milder weather forecasts or a slight easing in demand expectations, but its volatility means these levels will be watched closely for any signs of a rebound. The energy complex, overall, remains a dynamic and critical component of the global economic outlook. As we survey the landscape of sector performance this morning, the overnight futures give us a clear indication of where the market's attention and apprehension lies. The tech sector, often a bellwether, is certainly feeling some pressure. The Nasdaq futures are down, and many of the mega-cap tech names are following suit. Let's look at the individual stories. Giants like Microsoft, Amazon, Meta, and Google are all facing headwinds overnight, showing some declines. In particular, Google stands out as one of our worst performers in the overnight session. The dip in Google is notable, and it raises questions about investor sentiment towards some of the largest digital advertisers and cloud providers. Perhaps it's a recalibration after recent gains, or perhaps a broader concern about regulatory scrutiny or competitive pressures. Whatever the reason, it's a stock that will command attention once the US market opens. Visual: insert real animated chart for Google, worst performer. Conversely, defying the broader tech trend, Tesla is enjoying a very strong overnight bounce, standing out as our top performer in the pre-market. This surge suggests renewed investor confidence in its growth trajectory, perhaps driven by new production targets, technological advancements, or an improved outlook on global demand for electric vehicles. It's a testament to the fact that even in a cautious market, individual narratives and company-specific catalysts can drive significant upward movement. Visual: insert real animated chart for Tesla, top performer. Elsewhere, Apple is holding relatively steady, showing minimal movement, suggesting a degree of resilience for the iPhone maker amidst the broader tech turbulence. We also see some interesting sector-specific moves outside of tech, with Kroger stock rallying significantly. This boost is tied to the news that a former Walmart CEO is taking the helm, sparking optimism about leadership and strategic direction in the grocery retail space. This shows that while macro forces are at play, fundamental company news and leadership changes can still provide powerful tailwinds for individual stocks. The narrative around AI continues to be mixed, with Cathie Wood's ARK Invest seeing AI driving a prolonged capex boom, while other analysts are expressing concerns about the capital expenditure involved, particularly at companies like Microsoft. This ongoing debate will undoubtedly shape investment strategies in the coming months. The crypto market is certainly making its presence felt this morning, experiencing a significant pullback. Bitcoin is notably lower overnight, sparking renewed discussion and concern among investors. This movement underscores the inherent volatility of the digital asset space, reminding us that even with increasing institutional adoption, sharp corrections are always a possibility. Amidst this volatility, the actions and statements of key players become even more critical. Michael Saylor, the staunch Bitcoin evangelist and CEO of MicroStrategy, remains unwavering. His company, MicroStrategy, which is heavily invested in Bitcoin and consequently showing a significant dip this morning, continues its strategy. Saylor has explicitly stated that MicroStrategy will continue its policy of buying Bitcoin and has no intention of selling its holdings. Furthermore, he addressed concerns about MicroStrategy's credit risk by emphasizing their ability to refinance the debt, if necessary, reinforcing his long-term conviction in the digital asset. This strong stance from a major corporate holder provides a layer of underlying support, but it doesn't immune the asset from short-term price movements. Adding to the broader conversation around digital finance, Ray Dalio has issued a warning regarding central bank digital currencies, or CBDCs. He suggests that CBDCs could grant governments sweeping financial control, raising important questions about privacy, autonomy, and the future role of traditional banking. This warning from a highly respected investor like Dalio highlights the complex and often controversial aspects of digital currency development, extending beyond just speculative trading to fundamental societal implications. The crypto corner, therefore, remains a space of both high risk and high innovation, constantly influenced by market sentiment, institutional strategies, and evolving regulatory debates. As we look towards the trading day ahead, it's crucial to reiterate that the US market remains closed today. Our focus, therefore, will be squarely on the ongoing movements in futures markets, the performance of European and Asian markets as they open, and the continuous flow of news and investor sentiment that will shape the eventual US Open. The biggest overarching theme influencing everything will be the digestion of Kevin Warsh's appointment as the new Federal Reserve Chairman. Market participants will be scouring every past speech, every commentary, and every interview from Warsh for clues about his future policy direction. This analysis will drive futures movements and set the tone for the week. On the data front, while US markets are closed, several critical economic reports are on the horizon. We've seen updates from China, indicating consumer inflation rising less than expected and persistent producer price deflation. The UK is also expecting a marked fall in its CPI. These international inflation figures offer context for what the new Fed chair will be looking at. Domestically, while the actual report isn't today, expectations for US job growth to have picked up in January, with the unemployment rate steady, will be top of mind. The ongoing debate about why the economy is booming but the job market is lagging, as highlighted by NBC4, will be a critical point for the Fed's dual mandate. Beyond economics, we will continue to monitor geopolitical developments and corporate headlines. Any statements from other Fed officials, even interim ones, might offer subtle interpretations of Warsh's likely stance. Earnings season is always lurking, and while not in full swing, any pre-announcements or analyst downgrades, upgrades, like the one questioning AI capex at Microsoft, will resonate. The overarching theme for the next 24 hours is anticipation and recalibration as the market prepares for a new chapter in monetary policy. As we wrap up our morning update, the message is clear. We're at an inflection point. The appointment of Kevin Warsh as the new Federal Reserve Chairman marks the beginning of a truly transformative era for global financial markets. His leadership is expected to bring a renewed focus on price stability, potentially signaling a firmer hand on monetary policy and recalibrating market expectations around interest rates and inflation for the foreseeable future. This is not just a tweak, it's a fundamental shift that could ripple through every asset class. The overnight market movements, though subtle in the futures, reflect this underlying caution and strategic reevaluation. While individual stories like Tesla's strong performance and Google's dip grab headlines, the macro narrative driven by the Fed's new direction will be the dominant force. We'll be watching how bond yields react, how different sectors like tech and commodities interpret this new environment, and how global central banks adapt to the signals emanating from Washington.